I've noticed, and this is not what I had previously thought would occur, but when people invest in trust deeds, my previous thought is that they would give their money to a variety of brokers simultaneously. So they would have, you know, some here and some here and some here and some here. That doesn't really happen with us, I've noticed, is that we typically have virtually 100% of somebody's attention. If that's one piece of their investment world or all of it, we have almost 100% of their money.
Yeah, and I think what's happened is, you know, that's really been earned over the 17 years we've been together. I mean, they can research us on the, you know, a lot of people now will research the internet or look at the website or just referrals or things like that. And you just can't go, say, from today to 6 months from now if you're just starting up and have all of that background and track record. So people tend to get very comfortable when they do invest with us. And one question which kind of comes up from this, a lot of people talk about, well, you should diversify your money. Well, the beauty about the trust deed business is it does diversify your money.
Absolutely.
Because if somebody has $500,000, let's say, as an example, and the average loan is around 80 or so, well, you can get, you know, 6 trust deeds or something. And what I generally will do, I say, okay, well, let's do this. Let's just try to mix them up, different areas, different borrowers. So you don't have, like, it's not like you have $500,000 on one house with one borrower. You've really diversified their portfolio just within the nature of what we do.
When you look at a loan application from scratch, what is it? What are some of the positive things that you like to have there?
Yeah, probably the two most important things. One is you really do like to have experience, but I mean that's not essential. But the absolute must-have things in this business is cash reserves. Cash reserves trumps everything else, even credit per se, because a lot of people, 06, 07, 08, a lot of investors made choices to let a few properties go and save $500,000.
Correct.
So, you know, their credit's not going to look that good, but they have experience and they have funds available. So really those are the two things. Now, of course, if somebody has really derogatory recent credit, bankruptcy, things of that nature, those are going to impact it, of course. But generally, credit is not as important as cash reserves.
And I think one of the things that you can look at over the years is the results of the process. So when we look at a portfolio of something like $40 million of loans and we have our results, I think it speaks for the process. So we must be doing something awfully right.
Yeah, and I often will say that. Recently I had an investor come in that wanted to be an investor. Actually, they're doing their first one, and both of them had banking backgrounds. And that's kind of an interesting conversation because, see, they look at things, well, it's got to fit in this box, this box, this box, and this box, whereas what you mentioned, we just kind of have a big box. And our process somehow has gotten everything in this big box, and it just doesn't seem like there's a need to change it because that box is working so well.
And sometimes it's counterintuitive. I was speaking in front of an audience, and there was a lawyer there, and they asked if we cross-collateralized our loans with other property. And I said, no. I said, I think you would then be forced to loan to somebody who you really wouldn't want to loan to in the first place.
Exactly.
It sounds like more protection, but in essence...
No, you're exactly right, because with us, each one stands on its own. So if you got this thing right here and we won't make a loan on that, why would we be in a lesser position on this and then take something else? Like you say, you're actually not in as good a position.
But the borrower that will say yes to that is the wrong borrower, too.
Absolutely. He's the guy that nobody else will lend to.
Exactly.
And that's why he's willing to do that.
Now that's going to be your whole, your whole portfolio?
Yeah, exactly.
That's a bad decision.
Yeah, that is a bad decision.
What equity cushion do we look for when we fund a loan?
Yeah, we're using 100% obviously as the value of the house. We're going to always be in first position. I'm not sure if we mentioned that yet, but we'll always be in first position. And right now we're probably going to be 65% or under.
Okay.
That's where the comfort zone is, and that number will fluctuate a little bit depending on the type of market we're in. You know, the better the market gets, you tend to do a little bit more, and then if it's a slower market, maybe you back off a little bit. But right now, about 65% is where we're at.
I think that's the thing that private money has that standard lenders don't, is that we have common sense that really is the ultimate decider.
Yes.
Are we going to get paid back? Are we going to get paid monthly?
Right.
And it seems to be a really smart way to make loans. But I think when you have policies that say you have to fit inside of this parameter, we're loaning to people. When you think about, okay, hard money, gosh, 9.9, tons of our borrowers have so much money in the bank, they're rich just in the extra cash they have, but they're still borrowing money. Or they own 30 houses free and clear, and they're going to take 5 of them, refi them.
Right.
It's really an interesting process for them to get told no from a standard lender, and we end up with those loans.
Right, yeah, common sense. I mean, when I first started, this probably goes back now 30 years, but just when I first started in the business trying to do regular loans, I remember going on a refi appointment. Somebody had made all their payments, never been late, decent credit, and we were going to lower their payment by about $500. But because their debt ratio was like a couple percent too high in the bank's or lender's opinion, we couldn't do that loan. So right away I was like, where was the common sense in that? At $500 more, they're making every payment.
Exactly.
So here we're going to cut it by $500, but somehow that didn't make sense.
Yeah.
And that's kind of the common sense aspect really allows us, I think, to make the right decisions.
What are some of the things that when you see on a loan application or take a look at an overall transaction that makes you hesitant?
Well, probably the one thing would be, say, lack of cash.
Okay. And there's lots of seminars out there, and there's the words out, you don't need a dime of your own money. That's not true here.
And you know what? That's not true many places.
Yeah.
It really isn't. I mean, not if you want to get a good deal. I mean, you might be able to do something creative where you're putting yourself in a horrible situation. I don't know, but you are going to need cash. And then the second situation I see a lot, and I'll just bring this up because it popped in my head. A lot of times we'll get an application that has a borrower and a co-borrower.
Right.
Okay, a borrower is the guy that has all he needs to or wants to buy properties.
Right.
And the co-borrower is the one that has all the cash.
And no time or expertise.
Yeah.
Okay.
Now, sometimes that works, but oftentimes what happens is I tend to talk to this person a little bit, the one that wants to do it, but I always make sure I talk to the one with the cash to make sure that they understand exactly what's going on. Because sometimes that's not a good match. In other words, they don't really realize what's at risk. They're being told something, and they're risking their money. So you really try to analyze all aspects of an application, just so you make sure you're not putting anybody in harm's way.
What's interesting about what you just said is there's a chain of that type of an experience where the farther you get away from the transaction,
Yes.
The more problematic loans become. So we've never done a broker referral loan for that reason.
Yeah, and that might, well, it surprises a lot of brokers, but yeah, we're always, in that term, we're a direct lender, meaning we're always talking to the borrower or the person we lend to. We never get referred somebody where they're just a stack of paper.
Right, we don't have a firewall protecting the truth of the matter, let's say.
Right.
Well, and that's turned out to be a very valuable thing.
Yes.
Because just as we see sometimes investors are taking courses and then they live out of state and they want to invest in California and then they're being told this is the truth of this property purchase, and then they have a money investor who they're passing that on to, and then when it hits your desk you're going, guys, the truth isn't anything like this.
Right, yeah. No,
So,
yeah, you definitely, and that's one of my favorite calls if they take it correctly. Usually the person really appreciates somebody just sitting down and saying, hey, here's what's going on in California right now, or here's why that property isn't a good buy. So that usually goes over pretty well when you're telling them that.
In the rare instance where somebody stops making a payment,
Yes.
what do we typically, how do we approach that? Because that does happen on rare occasions.
Yeah, basically we're going to say send out a notice. Generally, obviously, I'll be trying to contact them.
Yeah, we'll be talking to that person long before we have to get sort of a formal.
Yeah, that's a situation where I'm always following the deals. As you mentioned, very, very rare, but I'm always aware of what it is. Sometimes it's a situation where maybe they're in escrow, and maybe they're just a little bit too overextended.
Yeah.
So a lot of times, you'll look at the situation. I'll talk to the investor and I'll say, hey, listen, I've been talking to the escrow officer. It looks like this is going to close, so you allow them to get to that point if you don't feel it's a risk. So because of the quality of the client, on the rare occasion when they do, you do always try to work out a solution.
Yeah, again, common sense is really better than, I don't know, a rigid policy in the sense, because each of those occurrences could have a reason where you go, okay, that's actually reasonable. I understand.
Exactly, and going back historically, when we're talking about owner occupants,
Right.
a lot of times going back that far, when somebody got behind and you tried to contact them by phone, you just couldn't get them.
Right.
That's when you kind of know you have an issue.
Mm-hmm.
And rarely that'll happen with an investor, but the one thing that I admire about people, and once again, just the rare occasion when we can't, but if I make a call to one of the investors, even if I don't like what they have to say, it seems like they always pick up the phone.
Okay.
And to me, that's a really big deal, because as long as there's a communication, there are solutions.
Yeah, we could make an intelligent choice at that point.
Right.
If you were an investor looking for a place to put your hard-earned money in a trust deed and talking to a broker, what are some of the questions that you would want to ask?
I think I would start off with how long have they been doing it? Want to get a little bit about their track record, what type of loans they do.
Okay.
I'd want to make sure, for me personally, just with the experience I have, we don't do any commercial.
Right.
Not that can't be profitable, but once again, for my personality, I would look for the most basic, item to lend on, which would be a single-family residence, maybe small units. So I'd want to see what they lend on.
Mm-hmm.
I'd want to see a little bit about their track record. I'd try to get information, because really I'm not as much on the internet as like, say, Aaron, for instance, but you can really learn a lot just by checking the internet. And I think one of the things that I feel the best about our company, I mean, I've had people say, geez, I've really researched your company on the web, and I just can't find anything negative. And, I know that's not the case with everybody, because, you see other examples of that.
Right.
So you'd want to check out, maybe that a little bit.
If somebody said, well, Craig, we're going to take your money and we're going to put it with our other investors in a pool.
Oh, that's the point. Yeah, everything we do is one investor for one house. Sometimes what people will do, and it's not a good way, I would never do it. If you put your money in a pool, what that means is, say they get $1 million together, and they can pretty much lend that on anything. And within, houses, et cetera. But the thing about a pool, it sounds good and it seems to work good until it doesn't.
Until it doesn't, yeah.
Everybody's happy with pools, and then once it stops working, that means, what happens is some of the assets in the pool start to go bad, and gradually it turns the whole pool sour, and then you just have a really big problem.
But you don't even know that's a problem, because you're continually getting a check,
right,
until all of a sudden you can't get any checks.
Exactly.
And it can become a big issue. And it doesn't even have to be with bad intent. The broker, now, he just has a vehicle that they have a lot of freedom. And the decision process is really taken away from the individual with the money. They've made the decision by putting it in the pool. That is their decision.
Exactly.
How it's spent is their after, not their...
Exactly. And even though the majority of the investors that we have historically they've been with us, and it's very repetitive, so I'll call them and say that, okay, here's what we have. I mean, I always send them a copy of the appraisal. So you can always identify, okay, this is what my money's going to be on right here. And as you mentioned, you don't have that advantage when you're dealing with a pool.
If somebody said, well, Craig, we're unusual. We get very high interest on our trust deeds, so we have first trust deeds at 15%. You'll be excited to know that.
Yeah, and see, unfortunately, there's a group that's going to jump at that, because
right.
I mean, I've actually heard that,
sure.
Unfortunately. And I would know that there's a risk yield reward.
You know the market well enough
yeah.
to know that that's a very risky borrower having no choices.
Yeah, and I mean, we could spend, just with the length of time probably we both in the business, we could go through probably 100 examples of people we know that have chased a scenario where the yield was higher without a very good result.
What's interesting too about that is not only the result was bad, but trying to get yield like that usually makes 80% of your money dormant looking for the yield.
Yeah, that's one thing what I like about what we've chosen to do with our funds. I mean, I like the fact that it's a longer term, so 100% of my money is working all the time at that interest rate.
Yeah, and when we started something like 65% LTV, and we're at a bottom of a market, at some point that becomes 50 or 35 or something, and you no longer think about that as a risky position. You don't even in the beginning, if you understand what's going on as far as the pricing and the firmness of the market. But it's just interesting that the loan program is actually a well thought out loan program, the 9.9% program, because it really took into consideration, okay, we have a chance to buy cash flow properties for once in our life, basically, in California, but we can't get any money. So you've got a private sector that would like to get ownership of those if they could and hold them long for the appreciation, and then there's another group that has $1 million that doesn't have a chance to get a yield. And so the marriage of those two actually was smart. But because of our reputation and your expertise in placing money wisely, we were able to make those people transition to that comfortably over time, to where they went from the short terms to the 8 years.
Yes.
And I don't think there's anybody sad about that, I mean, at all.
No, there's examples of people that 3 years ago I put in, say $1 million into the 9%. And literally, once again, they're just getting checks on that the entire time.
Yeah, they don't have to think about it or make another decision. It's
yeah,
pretty
versus
neat.
going in and out. And as you know, I mean, if it's dormant, you're not getting yield.
Right.
It doesn't matter what the note rate is once it gets paid off, because then your note rate is 0.
That's right.